Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari. Welcome to the episode, guys. This is episode 35. Starting from this episode, we're going to talk about individual companies. We're going to start analyzing a company, an episode, or actually two episodes, analyzing a company per 2 episodes. Yep. Today we're gonna talk about Skechers. You guys heard of it probably, most likely. It's a shoe company, and we'll do a deep dive into what this company is all about. We'll follow the checklist that we talked about in the previous episodes. If you haven't listened to that episode, please do check it out. It's called the checklist, Value Investor Checklist. I don't know what number it was, but
I don't remember either.
But be sure to check that out because we're going to follow that template as we analyze Skechers and future companies also. So do be sure to check that out. And so let's get started. Okay, so like I said, the checklist, we're going to follow the checklist, and the checklist largely answers largely 4 questions. The first is what is the company do, and kind of doing deep dive of the competitive analysis of the company, the moat, etc. So that's the first chunk. The second chunk is talking about its financials. The third chunk is talking about its management. And the last chunk is the valuation of the company. And what we want to do in this episode 35, is to talk about the business itself. So the first chunk, the very first chunk. And the following episode, we'll talk about the second and third and the fourth chunk. So let's do a deep dive into what Skechers business is about. Oh wait, before we do that, disclaimer.
Yeah, so I think what we're going to be doing here over the next however many episodes that we continue to do this is talk about individual companies. In my experience as a value investor, I get passionate and we talk about companies, and then I'll find out later that somebody went and bought shares in a stock of something that I talked about, and doing so without really doing any research or any knowledge of what the company was or how it worked. They just hear, Hari bought it, so I'm going to buy it too. So I want to encourage you to never do that. Value investing is only investing when you understand the business and understand what you're doing. If you're not, you're speculating. And if you don't remember what those mean, I would encourage you to go back to our, one of our first episodes where we talk about what is investing and what is value investing. What we're doing here is teaching you how to analyze businesses and how we analyze businesses using this checklist that may evolve over time and that may change. The purpose of this is for education and for entertainment purposes. It is for you to understand how to analyze a company and to how to think about that analysis, and then to take that and apply it to your own investment decision making. Because here's the thing about this is that you may get this hot stock tip. If you know nothing about this company, and let's say the stock goes down 10% or it goes up 50%, you don't know whether or not to buy or sell, right? Because you have no idea whether it's overvalued or undervalued because you haven't done the analysis. And that's why what we're trying to teach you here is not how to just do it yourself. Or just listen to somebody else and then just buy what they say. Because there's plenty of people who are going to give you advice. I'm trying to teach you how to do it so that you can figure it out for yourself. And then, I'm going to teach you how to fish instead of giving you a fish. And what I hope is that over the long run, this becomes a way for you to achieve your own financial freedom, that you never have to, you can always be reliant on yourself to make, good financial decisions. So,
excellent point there, Hari. All right, let's move on to the checklist, shall we?
Yeah.
Okay. So Skechers, tell us, we're just going down the checklist. And again, if you don't have the checklist with you, please go ahead and email us at info@valueinvestor.org to get a copy of this, because it is so important to have a checklist in front of you as we go down, and so you guys can follow along with us. So let's go dive deep into the business section of the checklist. So the question number one is, what does the company do? So what does Skechers do? And you should be able to answer this question in less than 2 sentences. So tell us, Ari, what does Skechers do?
So Skechers is a retailer of shoes that sells domestically and internationally, and they operate in over 100 countries. And in their subcategories of shoes, they are the number one retailer in a number of different areas, including walking, work shoes, casual dress shoes, and casual lifestyle shoes. I don't know how you would technically define all of those categories, what falls into what. But I think the thing that's interesting to me about Skechers is that most people see them as a kind of a low tier, kind of lower quality brand here in the United States. And that may have been true early on in their, infancy. But over the last 6 or 7 years, they have grown immensely internationally, and their business internationally is considered, a mid to a high, premium tier, shoe. When you were in Korea, I mean, I think you probably saw Skechers everywhere.
Yeah, I can speak from my personal experience. When you walk around South Korea, you see Skechers stores all around, and Skechers, has a really like you said, mid to high tier image over there. And you see if you read it in 10K, people talk, the management talks about the growth in South Korea, and that kind of speaks to the image there. It's it's very robust image. People like it. I think especially here, it's not really popular with people in their 20s and 30s perhaps and 40s, but over there, people in their 20s, even teens, 20s and 30s, it's popular over there.
Yeah, and I think the other thing, there's a couple of things about what you just said. So South Korea, I think, if you don't know much about it, I mean, culturally, South Korea kind of leads Southeast Asia in terms of fashion trends, music, that kind of thing. Yeah. The Korean culture is, what a lot of other Southeast Asian countries follow, like K-pop and other things.
Yeah. I'll also, maybe it's a both, but Southeast Asia, but like the entire Asia, generally speaking, I'd say East Asia, like Greater East Asia, including China.
Yeah.
Yeah.
Yeah, and so when Skechers is popular in Korea, it's on purpose. They're trying to promote that there, because then it means that it's popular in China, which they've translated that into a Chinese thing too. Yeah. And they're doing the similar thing in India, where they're just starting out but trying to expand into that market. So, 170 countries probably surprises a lot of people, because most people don't think of Skechers as an international brand. But I think the other thing that people don't realize about them is that they are a work and so they have memory foam in their shoes. Yeah. If you are working, and you're on your feet all day long, it's a very comfortable shoe to wear. A lot of people look at it, from that perspective. So when I think of them, I think, people think of sneakers and they think of, certain, specific types, but they actually cover a lot of different areas. And they're super popular amongst older people. So people in their 40s, 50s, 60s, and beyond, all wear it because, one, it's comfortable, and they tend to not have a lot of, they have a lot of brand loyalty. So when they're buying their shoes, which may not be as often as somebody in their 20s, they stick to the same brand just because they're not
don't want to change.
Yeah, they're not. Once they find something they like, they just kind of stay with it. So,
also, you talked about the senior population, people 60, 70 above, people like Skechers, but also it's a bimodal curve, because you have people in their teens. Yeah, the parents give them Skechers and they like it, so it peaks and then kind of trails downward in their 20s and 30s, and then kind of peaks back up.
Yeah, and especially very young children, also very popular with young children. So they have the light up shoes, and they have all the flashy colors and things like that too.
Well, so you're raising a child now. You give her Skechers, and
I mean, it's cheap, it's easy, and there's always the colors and styles that she likes. So and they have the branded shoes that the kids actually seek out. So, not that kids in their when they're 5 years old really know what brands are, but I mean they recognize certain things like and the colors appeal to them, and then the light up shoes and that kind of stuff. So I mean it's I think a lot of people don't pay attention to these brands because they think of, when they think shoes, they think Adidas, they think Nike, they think, those are probably the two that come to mind, top of mind for a lot of people.
Yeah.
And there's these other companies that, on the West Coast that are making stuff. But for the most part, Skechers is said, we're not going to attack that brand necessarily. We're going to go after everybody else. And they've done that very well, and they have a very loyal following there.
I imagine, like I talked about the bimodal type of curve.
Yeah.
I imagine if you look at Adidas, for example, or Nike, for example, you're going to see more like a bell curve. You have peaks in the 20s and 30s, and it trails off. And low, it doesn't really start off, it peaks starting from 20s up and then kind of trails down. So it's really targeting the areas that they're not targeting.
Yeah, well, and the other thing that Skechers is doing is they're also targeting areas like marathon runners, golfers. So they have a lot of athletic shoes that are targeted towards specific people. We're in Houston. The marathon here was last weekend. Skechers has a huge booth there. I think last year, I don't know about this year, but last year, someone that they sponsored won the marathon. They sponsor golfers who are winning, tournaments, and they have some fairly high label, people who are sponsors. Camila Cabello and I forget the golfers that they have. I think I don't want to misspeak on which. This is probably the least important part of who's sponsoring them, but for the most part, they don't sign the ridiculous deals that Nike does, where or Adidas gives James Harden a $300 million 10-year contract. They're signing much more modest type of deals, but they get a lot more value out of it, I think. And I think what you'll see as you go through and you analyze this company is they're a lot more value oriented. Like they spend their money a lot more targeted, and they don't waste it on. I mean, they could easily give James Harden a $300 million contract, but they're not targeting the basketball market, and they're targeting these under-penetrated areas. Yeah,
underserved, underpenetrated market.
Yeah, so
exactly. Should we move on to the next checkpoint?
Yeah.
Which is, does the business have a competitive advantage? Describe them in the category below. The categories are brand, network effect, switching cost, low cost, and lastly, intangible assets.
So let me give you just a couple more points on the business side.
Yep.
To kind of highlight, because I think that'll help with these competitive advantages, because I'm looking at my notes and I forgot to mention a couple of things. So Skechers used to be purely a domestic wholesale type of thing. They didn't have any stores, so they would ship their shoes to a quarter before the quarter that they were selling them in.
Yep.
And what they found was the margins weren't as good. And even though these were popular, so when I say domestic wholesale, that was they would ship it to a retailer like JCPenney's, Walmart, Target, insert name of some retailer here.
Yep. Finish Line. Or
Finish Line. And then what they started doing is in the last 6 or 7 years, they've started opening their own retail stores. Mm-hmm. So to give you an idea, the gross margin, which is the price at checkout, how much money does Skechers keep? For domestic wholesale is about 37%. For their retail stores, it's about 57%. And their international wholesale is about 48%. So it's a much higher margin in these international markets and in their own retail stores. Also, those markets, the international and retail stores, are growing a lot faster. Now, part of the reason for that is they are able to adapt to trends much quicker in these markets. By having retail stores. You buy something wholesale, you have to buy it a quarter in advance. You buy it retail, sell it at your own retail store, and you can, change in, a month time frame from the time you order shoes to the time it hits the store. So, and to give you an idea, just to finish this point, in 2017, which is, we're 9 months into 2018's fiscal year, about $3 billion of their $4.2 billion in sales came from the international wholesale and retail market, and those numbers are growing at about 20 to 25% a year, and the domestic wholesale is flat. So international is growing and is where all of their growth really is occurring, which is, I think, is frustrating a lot of people in the in Wall Street, because they focus solely on the U.S. market. But China and the rest of the world, the other 169 countries they're in, is where growth is happening. So now that we've laid that out,
Yep.
Competitive advantages.
Mm-hmm.
So, do they have a moat? Well, I think this is a little bit harder to say that it's not necessarily the strongest moat, but they have a brand moat, right? And I think when we say brand moat, I think they have a loyal customer base in the older demographics, in the younger demographics, and I think in the international markets they have a premium brand that kind of attracts people to their thing, and they also have this cultural interest in South Korea that's disseminating to the rest of East Asia, right?
Mm-hmm.
So I think that's a big part of their brand, is it's very recognizable in where they're growing fastest, right?
Yeah.
So I think that's probably their moat.
Yeah, it's interesting. I think. I mean, Skechers. Most people who are listening to the podcast, they're from the U.S. and a few from outside the country. But Skechers in the U.S., at least in our demographic, the 20s and 30s and 40s, it's not really recognizable as a brand, as a premier branded shoes. And so when you say, oh, Skechers, brand is one of their competitive advantage, it might not resonate with them.
Yep.
But the fact of the matter is, over there in Asia or outside of the U.S., it really resonates with a lot of people, the entire demographic from 0 to 100, wherever, the age-wise. Right. Here, it might, like we said earlier, it might not resonate with people in their 20s to 30s, but it does resonate with people a little bit older or younger.
Yeah.
So that's a brand competitive advantage, and certainly we talked about this before when we talked about competitive advantage in an episode. Brand competitive advantage is certainly a non-trivial competitive advantage that a lot of companies really ride on.
Right.
Yeah.
The only other thing that I would say from a moat standpoint is I don't think they have any sort of switching cost. I mean, anybody can go and buy shoes. Mm-hmm. The next pair of shoes can be something totally different.
Right.
But they do have somewhat of a low cost advantage in that they're offering a premium product at a lower price point, and they're selling that premium. So the same shoes that you're selling in Korea are selling here, but they're selling it at a higher relative price point. And that has something to do with tariffs and things like that. But international wholesale has a higher gross margin, 48% versus 38% for domestic wholesale. Most of those stuff is being made in Southeast Asia, whether it's in China or Vietnam, and then their retail stores are much higher margin for them, so they are able to capture more dollars for every shoe that they sell.
Yeah,
and that trickles down to the bottom line.
Yeah.
So I think that's an important, component to this, is that that they're a low cost provider in that they are doing it they're not manufacturing it, but from once they take shipment of it, it's essentially they're controlling that entire supply chain.
Yeah,
down to the customer.
Yeah, I want to mention a couple points there. One is, you talked about this earlier. When we talk about competitive advantage and we talk about companies that can produce things at a low cost, at the lowest cost perhaps.
Yeah.
When you have that moat, more often than not, companies that have that moat is the most efficiently ran.
Yes.
And you talked about that earlier. And so this is one of those companies that, they're really trimming off all that fat.
Yeah.
And getting it down to the minimum, bare minimum.
Right.
So that they're able to provide product at the lowest price point.
Right. And to that end, they're able to capture data on their customers to know what is the trended shoes, and then make that available. So when they find something is hot in South Korea, they order a bunch more and start shipping it to China and to, the rest of Southeast Asia. So it's a really important part of this is that they have to know their customer, know it well. So they have a joint venture that I think they purchased. It may have been a subsidiary or joint venture that they had in South Korea they purchased them.
2016.
Yeah, in 2016. And that allowed them to capture more information about their customers and do more stuff with it. So what I would say is that their moat really, to me, is a brand moat. That brand loyalty has some, it's not an unassailable moat, but it is a moat. And then this low cost provider, the retail stores provide them something that a traditional domestic wholesaler would not necessarily have.
Yeah.
So,
and one thing that you mentioned but you glossed over is the fact that they don't actually do their manufacturing themselves.
Yeah.
So there are factories, outsourced third-party factories in China and Vietnam. Those are the two places they go to manufacture shoes.
Right.
And they basically produce all of Skechers shoes.
Yeah.
So if you find Skechers shoes, they're going to be either made in China or Vietnam.
Right.
And after that value chain, after that manufacturing portion of it, like Hari said, they control they control distribution, warehousing, selling, etc.
Yeah, and to some of their distribution centers are fully automated. So they're packaging and shipping things, with minimal, labor, force to do that. Now, interestingly, in China, they haven't built their distribution center yet, and so sometimes they are, shipping orders, by hand.
Oh.
Right. So packaging by hand. So they've talked about this on Singles Day. They have, so for those of you who don't know, China, Singles Day is like, it's not the equivalent of Black Friday, but it's one of the biggest days of the year for selling stuff. And it was kind of largely invented by Alibaba. But, their number of pairs sold on Singles Day now exceeds, their entire quarters in like 4 or 5 years ago in China. So the brand has caught on. People are noticing it, and it's very popular in China now, and it's growing really rapidly.
Yeah.
So to me, I think the supplier, once they receive shipment and all the way to the customer, they basically know the entire supply chain there. So it's an interesting thing to help reduce their costs.
Yeah. You talked about the China distribution center. We'll talk about that more in a bit when we talk about the relationships, but that's an important point we need to remember to bring up. So that's kind of summarizes the competitive advantage and the durability of the competitive advantage. So with given that, what do you think is the long-term prospect for this company?
Well, so I think Southeast Asia is growing. They have an enormous population. So if you include China in East Asia, Southeast Asia, there's over 2 billion people there. And then you include India in that, and there's almost 3/5 of the world's population. So probably more. So with India, they're fairly early on. China is more of an established market. So I think they have a long runway ahead of them in terms of expanding sales in China, India, Southeast Asia. South America is another place that's somewhat populous and has, a growing presence as well. Yeah. I think the United States is, probably not going to sell as many pairs of shoes, especially in the wholesale market. But I think their own retail stores are going to continue to do very well. Yeah. And I mean, if you look at the price point in the U.S., for $100 shoes at Nike, you can get 2 pairs of shoes at Skechers or 3 pairs of shoes at Skechers. So it becomes a different conversation. And when you're talking about older people, who are buying, Skechers or young, kids, they're going out there to buy the shoes. They can afford more, it goes a lot further. So I think, and they're still making a good, deal of money off of that sale. So I think they're going to continue to grow in those specific niche areas. And so they're not an athletic brand like Under Armour or Adidas or Nike. But when it comes to casual work shoes, those kind of things, they're going to be very popular.
Yeah. So a lot of it, I mean, obviously you talked about the domestic retail as a growth engine, but a lot of the growth engine for Skechers is going to come from international sales, whether wholesale or whatnot. But a lot of it is riding on international sales, and you talked about East Asia as a source of growth there. But of course, we know that in China and many other countries out there, Asia, fakes, the counterfeits are a big problem over there.
Yeah.
So when you talk about long-term advantage, how does that play into effect here?
Well, I think if you talk to, so I am certainly not an expert on Chinese culture, but I think I have read articles about people in China see it as a badge of honor to actually own the real thing. And Skechers is not, like, if you're buying a Louis Vuitton bag, right, or whatever the Louis Vuitton sells, I don't even know, $2,000, right? Yeah. But you can get the knockoff for $50, right? Skechers, the knockoff is not, there isn't enough margin, difference that I think people would, like, you're buying a pair of shoes for $50. Well, the knockoff is going to be $20 or $30. So there may be some people who are picking that over the real deal. But I think for the most part, people are going to stick with the real deal because it's, of that, kind of cachet of owning the real thing. Mm-hmm. It's certainly a problem. Mm-hmm. But I don't know how to quantify it. Yeah. And it doesn't seem to be really depressing the sales growth, in China. So it's just growing fast.
Yeah, it's interesting to see. I think it'd be interesting to see how this quarter results come out and moving forward, how that plays into effect here. All right. The next bullet point, does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further reinvestment?
Well, so one thing to note about this company is the last couple of years they've been spending a lot of money to build out the distribution, the stores, it takes money to sell internationally, right? It's not like software, right? Where software, you have a server and anybody can access the server all over the world, and it's just how fast can you process transactions, right? When you're trying to sell physical goods, you have to have physical presence somewhere to do it. So the cheapest way to do that is, obviously, if you don't have the capital, is to do a wholesale kind of model. Mm-hmm. Well, so they're actually finding that the wholesale model doesn't have the same returns as joint ventures or these other things. Yeah. And in some countries it's political, in China it's not feasible to own 100% of that business, right? So they own a joint venture that they own less than 50% of. So they're investing in those areas to grow money and things like that. And so right now the operating margins are being depressed. What they said in their Q3 earnings call was that even though those are depressed now, they're seeing that they were spending money just to if they see areas of growth, they will continue to invest, which disappointed a lot of investors because they were expecting the leverage up of operating margins. So I think now we're seeing that China is slowing down economically. They're going to pull back on their investment, and I think they're going to see a lot more expansion in the operating margins in the next year or so, as they stop investing in those. So remember that if you don't remember what operating margins are, you can go back to our ratios talk. But effectively, operating margins are after you've sold the good. What is the cost of the item? Operating margins are almost everything else. It's the cost of distribution center. It's the cost of labor. It's the cost of shipping, and shipping technically is under the cost of goods sold, but it's the maintenance of all that infrastructure that is required to actually sell these things. So the leases that you have to pay for for the retail stores, that kind of stuff. Yep. So those distribution channels have now been paid for. Now the sales, they don't have to invest as much into them, so we'll see a spike in that operating margin. Yeah. So right now it's a little hard to tell, but I think that because their sales have not peaked yet, or they are slowing down a little bit. I think you're going to see them pull back on the investment side, and you'll see better returns.
Yeah, I think it's also interesting if you look at the cash flow statement, and then the management came out, right, in 10K, they came out and said the maintenance capital, and I know, Hari, you assumed a little bit higher than this, but maintenance capital, ongoing capital expenditure is between 45 to 50 million in between. But if you look at that and look at their entire CapEx in 2017, for example, it was about 136. Mm-hmm. So imagine the delta between 50, let's say 50, and then 136. The additional 80 is really going into the growth part of it instead of the maintenance part of it. Yep. And that's been the case for about 3 years so far. So 2015, 2016, 2017, they've been investing heavily. Right. So not only the 50 million for maintenance capital, but also additional 50 to 80 million in terms of investing into the business so that the business can grow in distribution centers and retail stores and all the other things. So it's interesting to see the cash flow statement and how it compares to what they're talking about. Okay, so let's move on to the next bullet point. And that is, does the business have favorable relationships with the following? Customers, suppliers, employees, and lastly, regulators/community.
So customers, I think I don't see any
red flags
there. I mean, they're not doing Gillette ads, or things like that, where they're trying to spice up sales by saying something controversial. They're a fairly standard type of advertising. I don't see, especially because their demographic is much older. Mm-hmm. Their ads are going to be targeted towards people that are less, they don't want to see controversy. They'll just drop the brand. I don't see any problem. Their suppliers 60% of their shoes are made in China. Yeah. So there could be a potential problem there with the trade war. But they also have the other 40 or so percent comes from Southeast Asia, so Vietnam. Yeah. So I think it would take them time to shift distribution to other places. Yeah. But I think it's possible. And I don't see any problems with their employees or regulatory issues. So for the most part, I'm not too concerned about any of those things.
Yeah, I want to mention this. When it comes to factory, when it comes to sourcing, about five manufacturers of Skechers, they basically cover 50% of the total purchase. Yeah. So they have to rely on 5 manufacturers for their 50% of their inventory, inventory. How do you wrap your head around this?
Well, so they actually had a problem with one of their manufacturers like 2 or 3 years ago, where it was they had a fire and it knocked out some distribution. They lost some inventory and they took a write down. What would be? I don't really pay attention a whole lot to that, because anything that happens in that sense is a quarter problem, not a long-term issue, right? And especially with suppliers like this, it's less of a problem that they're making a commodity product in some ways. You're making shoes. Lots of different people can do that, and they can find other people to do that without much of an issue. If they were making something a lot more technical, I would be a lot more concerned. Like if you were a hard drive manufacturer, when there was a tsunami that hit Thailand, it really knocked out everybody, the entire supply chain for, hard drives. Yeah. So, but shoes doesn't have that same problem, right? There's no special good that couldn't be made elsewhere. Yeah. And I think, they will find other places to have that, made. So
it's interesting. You're saying it's a quarterly problem, so you think it'll be resolved within a quarter in terms of shifting, maybe 2 quarters, be lenient about that.
Yeah, now if one of their suppliers was like 50% of their sales, I'd be a little more worried, but one maybe, if they're about 10%, I mean, it may dent a little bit, but not that bad.
So. Yeah, just to give you guys some statistics here. One factory, so 5 manufacturers cover about 47.5%, about 50%. And there's one factory that covers 17%. So that's a pretty sizable chunk of the inventory of the manufacturing capacity. But so that's that. And then employees are happy. You talked about that, and the regulators, communities. China obviously it's a heavily regulated
I worry
community.
less about regulatory issues in a retail business because, I mean, that's, there's always some small risk, but, that's not, they're a shoe company. It's not going to derail
Right.
a multi-billion-dollar company like this. So,
And then the last bullet point we want to cover, so that's relationships, which we just talked about. And the last bullet point is the company able to translate its moat into high returns on capital? Very important question here.
Yeah, so this is probably the most important question, right?
Yeah.
And if you look at it from a return on equity perspective, if you average out their net income over the last few years, because 2017 had a weird, they took a tax hit.
Oh, yeah, that was interesting.
Yeah, because they were required to by the way the law was set up. So in the U.S., and they're based in the U.S., so return on equity was about 15.99%. And it has been much lower in the past. It is ramping up as they use more retail stores. So I think you're seeing a better return on their investing. If you do it on a return on capital employed basis, so that is total assets, so it's operating margin, operating profit, EBIT, divided by the assets minus excess cash minus current liabilities. That number is closer to 27% return on excess cash. And if you say no excess cash, it's about 17.9%. So those numbers are very good. A shoe company like this, I'm fairly happy with that kind of number. And interestingly enough, over the last 5 years, they've grown at that number, about 17%. So I don't know how sustainable that is, just because they're getting to a larger size. But that tells you, that their returns are, especially now that they're going to start scaling back on the investing side, I think they're going to be doing very well on the return on investment. So I think they're going to be more and more profitable as time goes on, and as these things kind of investments pay off.
Yeah.
So.
Yeah. It was interesting because I looked at, we talked about this before we started the podcast. I looked at Nike yesterday and, not return on equity, but I looked at their gross margin and operating margin. It's interesting because even though their size is so big, I was trying to compare Skechers and Nike and how that compares in terms of gross margin and EBIT, operating margin. The Nike, they're doing like 30 plus billion in sales. So it's a gigantic company compared to, 4 here. Mm-hmm. Even though they're big, they're able to maintain that gross margin of, I think it was like 40 something percent or 50 something percent. So it's relatively high. And I think, if Skechers is in this path of growing their return on equity and is able to maintain this, this margin, be it operating margin or gross margin, I think they're able to grow at that sustainable level.
Yep.
Yeah. So that's it for the business aspect of Skechers. Again, we're following the Value Investor Checklist, and if you don't have it in front of you, please do send us an email at info@valueinvestor.org to get a copy of it. So that's it in the business aspect. Do you want to add anything else before we close out?
Not today. We'll talk a little bit more after we finish up with Skechers, just to kind of give an overview and give us some feedback. If you're send us an email at info@valueinvestor.org.
Yep. See
if you like this format and let us know what you think.
Yeah, exactly. We would be happy to have your feedback. Okay, so that is it. The part 1 of Skechers. In part 2, we will talk about its financials. We'll talk about its management. And lastly, we will talk about its valuation. So thank you all for joining us. This was episode 35. See you on the next episode.